Now, corporate Democrats, for some reason, love the payday loan industry, and they have sided with Republicans to show them that love. Now, if you guys can recall, Debbie Wasserman Schultz got a lot of money from the payday loan industry and also helped to pass rules in Florida in favor of the payday loan industry. So that's just an example, one example of many of Democrats that are actually in love with the payday loan industry. Others are included in this recent bill that was passed that definitely favors that same industry. Now, according to Zach Carter, writing for the Huffington Post, Representatives Gwen Moore, Democrat from Wisconsin, Gregory Meeks, Democrat from New York, Mark Warner from Virginia, and Gary Peters from Michigan have joined Republican Patrick McHenry and Senator Pat Toomey to co-sponsor something called the Protecting Consumers Access to Credit Act. Uh-oh. That sounds Orwellian. Now, according to Carter, the legislation would allow payday lenders to ignore state interest rate caps on consumer loans as long as they partner with a national bank. Now, let me break that down. So basically, payday lenders under this rule would be allowed to set any kind of interest rate on those loans. Now, for people who take out those loans, that means that they end up paying more in interest for those loans. Now, anybody who has to take these payday loans is likely not well off financially. I mean, nobody takes a loan, a payday loan, if they're not in sort of desperate need, right? This is a last resort for people with unexpected bills. Now, if you allow these lenders to raise interest rates, that actually serves to help trap low-income people into having to take more of these loans to pay off their previous loans, and it traps them into a vicious debt cycle. So let me give you some context into this, into what this bill actually does. Now, Carter explains, national banks have a great deal of flexibility with these standards thanks to a court decision made back in the 1970s. Now, they have to comply with the interest rate caps only in their home state, not those of the state where the person receiving a loan lives. So that's important. So what happens is, thanks to this rule, payday loan lenders and other predatory operations can go and ask banks in loosely regulated states. I'm talking places like Delaware, for example, that has very little corporate regulation, to go and issue the loans in their behalf. The payday lender will buy the loan after it's issued from the bank, allowing the bank to earn a commission for its service as a regulatory frontman. In 2015, a federal court had prohibited this end run around state laws in a few states. So they're like, hey, man, look, all you're doing is helping with these debt traps, right? Well, now, what Warner's bill does is it says, you know what, let's overturn this decision and actually protect cross-state rent-a-bank schemes. So this is more deregulation, right? And it gets rid of this ruling that actually tried to protect people from having access to these high-interest loans, right? And look, I mean high interest. Some banks would charge up to, or some of these lenders would charge up to 400% interest on that loan. That is insane, especially when somebody has to have that money thanks to an emergency. I mean, look, think about this, right? Just over half of Americans have reported not even having $1,000 saved up for an emergency. That's a disaster. You have your car break down, well, that's it. I mean, you're barely making it as it is. You're going to need your car to go to work, right? There's a lot of people out there that can hardly afford a $500 car bill. And if they have to take out one of these loans, you've got that 400% interest rate on top of that. That is so easy to fall into debt. I know I have actually taken out these loans before. So I understand how incredibly expensive and how easy it could be to get trapped in a debt cycle. Thank goodness I did not. I had a good job at the time. So there was just an emergency that I had to take care of. I was able to take care of that and, pay off that loan fairly easily. But there are a lot of people, like I said, that don't have that luxury. It is so very easy to fall up into this trap. And so, unfortunately, here come more corporate Democrats, just like the others that also helped Republicans to try to dismantle Dodd-Frank, only helping banks and lenders that end up hurting consumers. Gee, I wonder why Democrats are now also seen as the party of the rich and Wall Street. They are. I mean, the Republicans are too. There's no doubt about that. But look, Democrats love banks. Banks love Democrats. They give them all sorts of legalized bribes and political contributions so that these politicians will vote in favor of them, of these financial institutions. Now, when you do that, you end up having to turn your eye away from any of the struggles of the working class. That's not the kind of party the Democrats should be. But unfortunately, right now, that's the kind of party Democrats are. And the only way to eliminate this, to end this, is to get rid of the influence of corporate money in politics. You've got to get the money out, or you're going to continue to see these Democrats, these corporate Democrats, not only get elected, but then serve the banks and serve their donors. Hey everybody, thanks for watching this video. If you want to see more like this, please hit the subscribe button below. And if you want to support truly independent progressive media, please consider becoming a patron at patreon.com/TYTNation.